Let's talk about one of the biggest legends in the world of trading. His name is Takashi Kodagawa, but online, everyone just knows him as BNF. He is a Japanese day trader who did something that sounds completely impossible, almost like a myth. Starting with just yen 1,600,000, which is about $16,000. He turned that small stake into an incredible yen 18 billion in under 8 years. That's over $150 million. He didn't do this from a fancy Wall Street office with a team of analysts. He did it all by himself, from a simple apartment in Tokyo, just staring at his computer screens. His story got famous after one specific, almost unbelievable trade. In 2005, a big bank named Mizuho Securities made a typo, a huge typo. They tried to sell one share of a company called JCOM for yen 610,000, but instead, they accidentally listed 610,000 shares for just yen 1 each. BNF saw this insane error happening in real time and jumped on it. He bought a massive number of those shares at the rock bottom price. Within minutes, he sold them for a profit of over yen 2 billion or about $20 million in a single day. This trade earned him the nickname the JCOM Man and put him on the map. But here is the most incredible part of his entire story, and it's the one thing that most people miss. He achieved this massive success without using leverage. In the trading world, leverage is like borrowing money to make bigger bets. It's how traders can turn small price movements into huge gains, but it also means they can lose everything just as fast. BNF completely avoided this. He only traded with the money he actually had in his account. This method is slower and safer, but he proved that with the right strategy, it can still lead to mind-blowing results. BNF didn't trade everything under the sun. He wasn't involved in cryptocurrencies. He wasn't involved in Forex. He wasn't involved in commodities like gold. He wasn't involved in commodities like oil. He chose a specific battlefield, the Japanese stock market, primarily the Tokyo Stock Exchange. This was a deliberate choice. By focusing on his home market, he had a significant advantage. Local companies, the culture of Japanese investors. And he was awake and alert during the market's most active hours. He didn't have to stay up all night for New York. He worked his own time zone. The Tokyo Stock Exchange provided the perfect environment. It's one of the largest markets, tons of liquidity. Liquidity. How easily you can buy or sell without big price moves. For BNF, who made dozens of trades a day, that was critical. He needed buyers to appear seconds or minutes after he traded. He stuck to well-known large-cap stocks traded heavily. He avoided smaller, obscure companies where he could get stuck. Another key advantage, volatility. He wasn't after slow, long-term investments. He was a day trader. He thrived on short-term swings. The TSE moves on economic news. It moves on earnings reports. So, what was BNF's actual strategy? It was surprisingly simple in theory, though very difficult to execute in practice. His main approach can be called divergent swing trading, a method of buying stocks that have dropped too far, too fast. He looked for companies that were fundamentally sound, meaning they were still good businesses, but they had experienced a sharp price drop due to bad news, market panic, or some other short-term event. He wasn't buying falling knives blindly. He waited for the panic to start to fade, and the price to begin bouncing back. He was a master of reading market psychology. When bad news hits, many investors panic and sell without thinking. This wave of fear pushes the stock price down, often much lower than its true value. BNF saw this overreaction as a massive opportunity. He would watch a stock plummet. He patiently waited for selling pressure to slow. He looked for the moment when the last panicked seller had given up. That was his signal to enter the trade, right before bargain hunters and rational investors stepped back in. While buying major dips was his signature move, it wasn't the only way BNF made money. A huge part of his daily activity was a technique called scalping. Scalping is a very high-frequency trading style where the goal is a large number of trades for very small profits. Not looking for 10%, not 20%. A scalper might take just 0.5% or even less. Tiny wins repeated dozens or even hundreds of times can add up to a significant amount by the end of the day. This approach perfectly complemented his core strategy of buying reversals. While waiting for the perfect dip buying opportunity to set up, he didn't just sit on his hands. He would actively scalp stocks that were showing strong short-term momentum. If a stock was clearly trending upwards for the day, he might buy it and sell it just a few minutes later for a tiny gain. He would rinse and repeat this process as long as the trend held. This kept his capital working and generated a steady stream of income, keeping his account growing even on days when no major reversal trades appeared. To execute his strategies with such precision, BNF relied on tools that gave him a deeper look into the market's mechanics. One of his most important tools was the Level 2 order book. If you've ever looked at a stock quote, you've seen Level 1 data. The current bid, the highest price someone is willing to pay the ask, the lowest price someone is willing to sell. For Level 2 data goes much deeper. It shows you a ranked list of orders, buy orders, sell orders, price for each order, number of shares for each order. For BNF, the Level 2 screen was like seeing the market's DNA in real time. It allowed him to gauge true supply and demand. For example, if he saw a huge wall of buy orders stacked below the current price, that meant strong support, a floor. Conversely, a massive wall of sell orders above price meant heavy resistance, a ceiling. This info was invaluable for timing entries and exits. As a stock was falling, he would watch the Level 2 screen intently. He'd wait for selling pressure to exhaust, sell orders getting smaller, buy orders holding or growing. That was his signal panic was subsiding. Time to consider entering. It gave confirmation beyond the price chart. This might be the single most important lesson from the entire BNF story, and it's the one that goes against almost everything you hear about getting rich quickly in the markets. He did not use leverage. Let's make that crystal clear. Leverage or margin trading is when your broker lends you money so you can trade with a much larger position than your account balance would normally allow. For example, with 10-to-1 leverage, your $10,000 account could control $100,000 worth of stock. It sounds amazing because if the stock goes up 1%, you don't make $100. You make $1,000. But here is the brutal downside that catches everyone. If that same stock goes down just 1%, you don't lose $1,000. You lose $1,000, or 10% of your entire account. If it goes down 10%, your account is completely wiped out. You get a margin call, and your broker forces you to sell everything at a massive loss. Ultimately, BNF's success wasn't just about his strategy or his tools. It was about his mindset. The stories about his lifestyle are legendary for their simplicity and extreme focus. He reportedly lived on a diet of instant noodles. He slept very little. He dedicated his waking hours to watching the market. He wasn't interested in the trappings of wealth. Even after making hundreds of millions of dollars, he continued to live in a modest apartment. He avoided flashy purchases like sports cars. He avoided luxury mansions. His entire life was optimized for one single goal: to be the best trader he could possibly be. So what is the practical takeaway from his incredible journey? The most powerful and accessible rule you can apply is this: define your risk before you enter a trade. If the trade hits that price, you sell. No questions, no hesitation.